While the world watches China and the United States, something incredibly important is happening in another Asian nation that could shake the entire global economy. It looks like Japan is heading towards a crisis, and the reason lies in how the Japanese economy is structured. But I'm asking you to look at this not as an outside observer, but as a direct participant in these events. Because Japan has far more serious influence on the world economy than it might seem. This country is one of the largest creditors on Earth. It holds over $1 trillion in U.S. Treasury bonds. And for decades, it has been the driving force behind some of the riskiest financial operations in the world. So what's happening in Japan right now could very well lead to stock market crashes around the globe, and even trigger the next global recession. Have you ever looked at Japan from this perspective? But what could be causing such changes? And what risky financial operations have been tied to the Japanese economy? Hold on. Before we dive into this research, I need to know something. Where are you joining from? And what time is it there right now? Country, city, local time, put it all in the comments below. I really want to see how global this is. Let's start with something non-obvious. Japan's population, or more accurately, Japan's rapidly aging population. The average age of residents in this country exceeds 48 years. This is one of the highest indicators in the world. Approximately 30% of the population consists of people over 65 years old. And if you look at the demographic charts, there's no doubt that the Japanese nation is in a demographic crisis. Birth rates are falling, mortality is rising, and the population continues to age. It's even projected that by 2050, Japan will lose about 20 million people, which is almost equivalent to the entire population of Australia. Can you guess how this affects the economy? After all, demographics essentially show who in the country earns money, who spends it, and who retires with it. And there must be balance in this system. Right now in Japan, there are fewer and fewer young people. The workforce is shrinking, economic growth is slowing, tax revenues are declining, and at the same time, healthcare and pension costs are rising. In other words, if a country has poor demographics, it probably won't have a foundation for significant economic growth because tax payments are low and social spending is high. But how has Japan managed to maintain a high level of economic development all these years? After all, it had demographic problems before, but the country continued to be among the states with the strongest economy in the world. The answer will remind you very much of the scheme in the USA, because the only way to keep such a system working is to borrow money. That's exactly why Japan now has the highest government debt to GDP ratio in the developed world, which is over 250%, and it continues to grow. By the way, in the USA, this ratio equals 122%. But we'll return to the relationship between these two countries later. For now, let's note that Japan has enormous government debt. But at the same time, the Japanese are holders of a large portion of U.S. government debt. Sounds contradictory, right? It looks as if your friend is borrowing money from you, but at the same time is lending even more money to another friend. But this is only on the surface, because over 90% of Japan's government debt is in the hands of Japanese investors. Moreover, approximately half of all government bonds have been purchased by the Bank of Japan. Another 15% of the debt belongs to commercial banks, 20% to insurance companies, 7% to pension funds. And only the remaining 7% of Japanese government debt belongs to non-residents. But how does this scheme with government bonds even work, and why has this become the norm for Japan? To understand this, it seems we should look into the very essence of government borrowing. Every government has a large number of expenses, and when its own budget isn't enough for all these expenses, the government issues bonds. The point of government bonds is that investors lend the country money for a certain period at a certain interest rate. And here's a very important point. After the sale, bonds on the secondary market live their own life. They're resold and repurchased, become more expensive or cheaper. But the government pays exactly what was declared in advance at the time of issue. And from the difference between these market adventures of bonds and the initial cost, the return on investment is formed. As a result, the government gets the loan it needs. Investors receive fixed, predictable income, but at the same time can resell bonds and earn on the price difference. Or not earn, but on the contrary, lose, depending on the market situation. Sounds complicated? Let's look at the numbers. Everything will become clear. Some Japanese investor bought government bonds with a face value of 100,000 yen, with a coupon income of 5% per year and redemption in 1 year. This means that over the year, he will receive 5,000 yen in profit, and after the specified period will get back his 100,000 yen. The return on this loan will equal 5%. But if demand for these bonds in the securities market increases, the price will also increase. And here confusion often arises with understanding yield and profit. Let's assume that the bonds began to cost 105,000 yen. Another investor bought these securities from the first investor, and in a year he will also receive 5,000 yen from the government. Only the yield for this investor will be 0, because at the end of the loan term he will receive the nominal 100,000 yen, not the 105,000 spent. And taking into account the coupon income of 5,000 and the face value of 100,000, the investor will simply get back what he invested. But here's what's amazing. As you remember, half of all Japanese government bonds belong to the Bank of Japan, which means half of the income from bonds also goes to it. And here begins the most interesting part. The Bank of Japan is one of the few central banks in the world that is not completely owned by the government, but the larger share of its stock is still in the hands of the state, and this is enshrined in law. That is, you can't say it's part of the government structure, but you can't call it independent either, because other shareholders have no influence on bank management, and the bank's leadership still takes into account the government's interests. Therefore, the Bank of Japan annually transfers a significant part of its profit to the state budget. This is even written into law that after deducting expenses, taxes, contributions to the reserve fund, and dividend payments to shareholders, the remaining part of the profit is completely transferred to the Treasury. For example, last year the Bank of Japan allocated a record amount to the government of 2.17 trillion yen. That's almost $14 billion, which was about 95% of its net profit. However, there's another fact here that simply amazes the imagination. For a long time, Japan had a 0 interest rate on loans, and this is not an exaggeration. That is, the bank really issued loans just like that, without interest. How did this happen? In the early 90s, Japan faced a financial crisis, which led to prolonged deflation and economic stagnation. Prices for goods and services were falling. This reduced consumer spending and investment. The Bank of Japan was sounding the alarm and trying to stimulate the economy, for which it had to reduce interest rates to 0 and even introduce negative rates starting in 2016. Yes, it sounds like fiction. You borrow money from the bank, don't pay interest for it, and return an amount even less than you borrowed, albeit by only 0.1%. But it's true, because the Bank of Japan did everything to stimulate lending and investment. This amazing fact served as the basis for an entire era of easy money. Have you ever heard of such an investment strategy as the carry trade? Not a very well-known scheme for us, but in the case of Japanese yen, it became a real obsession. Carry trade is an investment strategy where you borrow money in a currency with a low interest rate and invest it in instruments with higher returns in other currencies. Your main goal is to earn on the interest rate difference. Here's a simple and conditional example. Let's say the yen to dollar exchange rate is 100 to 1, and the rate at which you can take a loan in yen is 1% per year. You borrow 1 million yen, immediately exchange them for $10,000, and buy some bonds in the USA that will give you 5% income in a year. A year passes, you receive your $10,500. It's time to repay the loan in yen. Let's say the exchange rate hasn't changed. Then for your $10,500, you will receive 1,050,000 yen. You return the original million to the Japanese bank, plus its interest of 10,000 yen, and you're left with your profit of 40,000 yen, or $400. But what if during this year the yen weakened, and now they give 105 yen for $1? That only works in your favor. After all, now for your $10,500, you will receive 1,102,500 yen. You give the bank back the loan with interest, and you're left with 92,500 yen, or almost $900 in profit at the new rate. But it can work out differently. If the yen strengthens, for example, to 95 per dollar, then you won't have any profit. Instead, there will be a loss of 12,500 yen, or $130 plus. So carry trade is profitable as long as the funding currency rate, in our case the yen, remains stable or weaker. If it grows, expect losses. Now multiply these numbers by billions or even trillions. Can you imagine the scale? This is exactly what we were talking about at the beginning of the video regarding these financial operations. For example, in 2023, interest rates in the USA exceeded 5%, while interest rates in Japan were still negative. And this created a huge incentive for people and companies to borrow yen, invest them in US assets, and earn on the interest rate difference. According to Bloomberg estimates, the volume of such transactions using yen at their peak reached hundreds of billions of dollars around the world. But it seems it's time to talk about the consequences. There's no easy money scheme that could exist forever, and the carry trade story in Japan continues to work only as long as interest rates remain low and the yen remains weak. As soon as the yen begins to strengthen and interest rates rise, this disrupts the usual trading scheme. Borrowing yen becomes not so profitable, and investors have to sell their assets in the USA to cover losses, and this is exactly what started happening in 2024. The Bank of Japan raised interest rates for the first time in decades. The yen rose more than 10% in just a couple of weeks, and what followed was a significant event. The Japanese market lost huge amounts of money in just 3 days. American stocks were sold off, and the price of Bitcoin fell. Now, in 2025, the Bank of Japan continues to tighten policy. You may have wondered what significance this has for us if we don't live in Japan or the USA. The thing is, the global market has long used this Japanese scheme, whether we knew about it or not. Because for decades, this country has been the largest creditor among all states. Japan's net foreign assets amount to $3.7 trillion. And as you remember, it is the largest holder of U.S. Treasury bonds worth over $1 trillion. Japanese institutions also owned American stocks, corporate debt, and even real estate. All the money that went out of Japan actually raised asset prices and lowered interest rates around the world. And the reason why the land of the rising sun had so much free money to send abroad comes down to those very zero interest rates. The carry trade scheme essentially became one of the most important financial schemes over the past 30 years. But now everything is about to change. In May 2025, yields on 30-year Japanese government bonds exceeded 3%, and on 40-year bonds reached 3.6%, which is a record high for the Japanese market ever. These changes are important because government bonds are considered the most reliable and stable securities in the country. And when investors felt that their investments are not so risk-free, they wanted to receive more profit from their money. Why? Because their confidence is weakening. And here it's time to remember that Japan's government debt is 250% of GDP. And the only reason this situation hasn't led to a crisis is that the Bank of Japan could issue new money and buy up government bonds. But now, when the central bank decided to slow down, the financial market began to test how much Japanese bonds are really worth without artificial demand from the government. And it seems Japan didn't pass this test because bond sale auctions failed. But investors still need somewhere to invest, and they're looking for alternatives. For example, Metaplanet is Japan's largest investment company known for its Bitcoin accumulation strategy. And over the past few weeks, Metaplanet shares have risen sharply, probably because investors view it as a kind of protection against the collapse of the Japanese bond market. And this is logical because when people lose confidence in the government's ability to manage government debt, they want to invest their money in something not connected with the usual centralized assets, for example, in Bitcoin. And now let's return to the relationship between Japan and the USA. We already mentioned that Japan is the largest holder of America's government debt, but now some Japanese institutions have begun to refuse foreign bonds, including the purchase of U.S. Treasury bonds. As interest rates in Japan rise, the yen begins to strengthen, and loans become more expensive. This means that it's no longer as profitable for Japanese investors to invest borrowed money in assets of other countries. And if this trend continues, the USA could actually lose one of its largest creditors. Remember, we recently talked about how China is massively selling off U.S. Treasury bonds. And what we talked about in that episode could happen with Japan, too. The sale of U.S. government bonds means huge borrowing costs for American consumers, increased pressure on the Federal Reserve, and even more instability in bond markets. Well, Japan is now in such a position that any step will have serious consequences. If you add up the value of all securities owned by the Bank of Japan, you get about 1.3 quadrillion yen, or almost $9 trillion. This means that even a small increase in interest rates can have serious consequences. If the interest rate in Japan rises, for example, by 1 percentage point, this in itself will add about 13 trillion yen, or $85 billion in annual interest payments. That's more than Japan spends on its entire operating budget for the year. And what do you think the Japanese government can do in such a situation? There are two scenarios, but both are losing ones. The first option is to raise interest rates to fight inflation and protect their currency. But this could lead to undermining the state budget. To better understand what we're talking about, imagine that you take out a huge mortgage loan at a very low but floating interest rate. If the rate starts to rise, this will mean that the monthly payment will increase by a huge amount, and you simply won't be able to repay the loan. The second option suggests that interest rates can be kept low so that the government can continue to borrow money. But this will lead to a fall in the yen exchange rate. And when the yen weakens, imported goods become much more expensive. It's as if you had a low interest rate on your credit card, but every time you go to the store, everything costs more than last week, and the cost of living in general is rising. A difficult choice, you'll agree. But this is a consequence of the fact that Japan's economy has been based on so-called cheap money for many years. And what's next? When assets that have always been considered stable cease to be so, people begin to believe more strongly in alternative investment methods, such as Bitcoin. And perhaps what crypto enthusiasts have been saying will turn out to be true in the end. The economic system of countries based on debt loses its stability in the long term. And increasingly, beliefs appear in the market that governments cannot get out of the current situation. They won't be able to raise taxes quickly enough to cover their expenses. But no one is going to reduce these expenses either. So what's left for them? Default again? So let me give you 3 clear conclusions from all of this. First, Japan's economic model, which worked for 30 years, is breaking down right now in 2025. The era of zero interest rates and infinite borrowing is over, and the consequences will be felt globally. Second, the carry trade unwind isn't just a technical market event. It's the dismantling of one of the largest financial structures of the modern era, affecting trillions of dollars in global assets. And third, what's happening in Japan is a warning to every debt-based economy, including the United States, with its now over $38 trillion national debt. When trust in government bonds erodes, there's no easy way out. Here's my warning to you. We're witnessing a fundamental shift in global finance. Japan cannot stop what's coming because the mathematics of debt and demographics don't negotiate. And when a creditor nation of Japan's size begins to pull back from global markets, the ripple effects hit everyone. Your retirement accounts, your currency's value, your country's borrowing costs. All of it is connected to what we just discussed. The financial system we've known for 3 decades is entering uncharted territory, and very few people are paying attention. So what should you do? Stay informed. Understand that what seems like a distant problem in Tokyo could affect your wallet next month. Diversify your thinking about money and assets. And most importantly, stop assuming that governments and central banks have everything under control. They don't. The math doesn't work anymore, and we're all participants in what comes next, whether we realize it or not. Thanks for watching till the end. If you're here, you're one of those who want to understand how the financial system really works. Subscribe, new research tomorrow, and drop a comment. What do you think about this? Your perspective matters.